Investing today feels more complicated than ever. There are thousands of ETFs, hundreds of opinions, and every expert seems to have a different favorite. So let's make it simple. If you could only choose one ETF to buy and hold forever, the one you'd trust to build wealth over the long run, which one would it be? That's what we're going to find out. When we talk about a forever ETF, there are a few things that really matter. It has to be diversified, it has to have a proven track record, and it has to be low cost. Let's break that down. First, diversification. You want an ETF that spreads your money across many sectors and companies, not one that depends on a single theme or trend. A forever ETF should give you exposure to the entire market, so you're not betting on any one company or industry. Second, a long track record. The fund should have at least 10 years of performance history, enough time to prove how it behaves in both bull and bear markets. Short-term results can be lucky. Long-term results show reliability. And third, low fees. The expense ratio may look small, but over decades it makes a big difference. Every fraction of a percent saved on fees means more money compounding for you. Now that we have these ground rules, let's see how different ETFs perform when we apply these rules. Let's start with the broad market ETFs, because they form the foundation for most portfolios. Among the most popular options are VTI, Vanguard Total Stock Market ETF, VT, Vanguard Total World Stock ETF, and VOO, Vanguard S and P 500 ETF. Let's look at how they compare. VTI gives you exposure to the entire US stock market, from large companies to small caps. It has a very low expense ratio of 0.03%, which means you're paying just 3 cents a year for every $100 invested. Its 10-year annualized return has been around 11%, with moderate volatility that reflects the broader US market. VT, on the other hand, gives you both US and international exposure. It's globally diversified, covering thousands of companies across developed and emerging markets. Its expense ratio is slightly higher at 0.07%, and its 10-year annualized return sits closer to 8%, partly because international markets have lagged behind the US in recent years. And then we have VOO, which tracks the S&P 500, the 500 largest US companies. It's extremely liquid, highly diversified within the US, and has one of the lowest expense ratios in the entire industry at 0.03%. Over the past decade, it has delivered an average annual return of about 12%, with volatility that's very manageable for long-term investors. So, all three of these ETFs meet our basic rules. They're diversified, time-tested, and low-cost. But when you look at historical performance and expense ratios side by side, one starts to stand out. Now, that's just one group, the broad market ETFs. There are other categories that many long-term investors also consider, like dividend-focused ETFs for consistent income, and growth-oriented ETFs for higher potential returns. Let's take a look at those next, and see how they compare on the same key numbers: volatility, historical returns, and cost. Now, let's talk about the second group, dividend-focused ETFs. These are designed for investors who want steady income in addition to growth. They usually hold companies with strong balance sheets and a history of paying and increasing dividends over time. Among the most popular dividend ETFs are SCHD, Schwab US Dividend Equity ETF, VIG, Vanguard Dividend Appreciation ETF, and DGRO, iShares Core Dividend Growth ETF. Let's look at each of them. SCHD focuses on quality dividend-paying companies, firms that have consistently delivered profits and strong cash flows. It has an expense ratio of 0.06%, making it very cost-efficient. Over the past 10 years, it has delivered an average annual return of around 11%, with moderate volatility. Its dividend yield is generally close to 3.5%, which adds a steady stream of income for long-term investors. VIG takes a slightly different approach. It tracks companies that have increased their dividends year after year, rather than just offering high yields. Its expense ratio is 0.06%, and its 10-year annualized return is about 10%. Volatility is slightly lower compared to SCHD, which makes it suitable for conservative investors who value consistency. DGRO focuses on companies that not only pay dividends, but also have room to grow them in the future. Its expense ratio is 0.08%, and over the last 10 years, it has delivered around 10.5% annually. Its volatility is moderate, similar to SCHD, and it offers a dividend yield close to 2.5%. When you compare these three, you'll notice something interesting. They all have stable, long-term returns and offer a good mix of income and growth. However, compared to the broad market ETFs we looked at earlier, dividend ETFs tend to have slightly lower total returns because of their focus on mature companies. That brings us to the third and final group: growth-oriented ETFs. These are designed for investors who can handle more ups and downs in exchange for higher long-term returns. Some of the popular growth ETFs are QQQ, Invesco QQQ Trust, SCHG, Schwab US Large Cap Growth ETF, and SPYG, SPDR Portfolio S and P500 Growth ETF. Let's take a look at how they perform. QQQ, which tracks the Nasdaq 100, is heavily weighted toward technology companies like Apple, Microsoft, and Nvidia. It has an expense ratio of 0.2%, higher than others on our list, but it has delivered an impressive 10-year annualized return of about 16%. The trade-off is volatility. It's higher, especially during market downturns, but the long-term performance has rewarded patient investors. SCHG focuses on large-cap growth stocks within the US market. Its expense ratio is 0.04%, and it has produced a 10-year annualized return of around 13.5%. Volatility is moderate to high, similar to QQQ, but the lower fee and broader diversification make it appealing for many investors. SPYG also tracks large cap growth companies from the S&P 500. It has one of the lowest expense ratios in this group at 0.04%, and its 10-year average return sits close to 13%. Its volatility is slightly lower than QQQ, but still higher than the dividend or broad market ETFs. So as you can see, growth ETFs have historically offered the highest returns, but they come with more price swings. They can be great for investors who don't mind short-term volatility in exchange for higher long-term growth. Now that we've seen how all three categories perform, broad market, dividend-focused, and growth-oriented, it's time to bring them together and find out which one truly stands out when we apply all our rules. So, after looking at all three groups, which one actually deserves to be called the Forever ETF? Let's find out. When we compare everything side by side, one ETF consistently checks every box: diversification, performance, low cost, and a long proven track record. VOO gives you ownership of 500 of the largest, most successful companies in America. It covers every major sector: technology, healthcare, energy, consumer goods, and more, giving you instant diversification. Its expense ratio is just 0.03%, among the lowest in the world. Over the past 10 years, VOO has delivered an average annual return of around 12%, with moderate volatility that's comfortable for long-term investors. What makes VOO special is its simplicity. You don't have to guess which stock or sector will perform best. As the US economy grows, VOO grows with it. Let's see what that could mean in real numbers. If you invested a lump sum of $10,000 and simply left it for 30 years, at a 10% average return, it could grow to about $174,000. But if you invested $500 every month over that same period, your total contributions would be $180,000, and your portfolio could reach nearly $1.2 million. That's the quiet power of long-term compounding. You don't need to predict the the market. You just need to stay consistent and let time do the work. So if you're looking for one ETF to buy and hold forever, VOO remains one of the strongest and most reliable options available today. Diversified, low cost, and built to last through every market cycle.